Your gold just crashed 21%. Your silver lost 41%. And while that was happening, while your screen was red, China was quietly executing a 634 billion move that almost nobody has connected yet. I found the trail, every dollar of it, exposed, documented, sitting right there in US Treasury filings. And by the end of this video, you are going to see exactly where that money went, what China is building with it, and what it means for the future price of every single ounce you own. Once you see the full picture, you cannot unsee it. Welcome to Clear Tax Lab, where we expose what mainstream financial media won't show you. If this is your first time here, this is where I break down what mainstream financial media will not show you. If this analysis helps you, like the video and subscribe. It's free and it helps the algorithm show this video to more people. Now, if you have been following my channel, you already know about the crash. Gold from 5,068 to 4,400. Silver from 121 to 72. Kevin Walsh CME margin hikes, Shanghai squeezing at the same time. I've broken all of that down in previous videos, links in the description if you want the full crash analysis later. But do not leave this video, because what I am about to show you today is the reason the crash happened and the reason it does not matter. You also know about China's silver export controls from my earlier video. 44 approved companies, 60 to 70% of global supply locked down effective January 1st. Today is different. Today, I'm going to show you the full strategy, not just the gold buying, not just the silver controls, the entire 7-piece plan connected, sourced, and verified. Because what China is doing is not random. It is the most coordinated financial strategy any nation has executed in modern history, and every single piece of it is already live. And one number I found buried in a COMEX inventory filing is so extreme, so broken, that when I show it to you later in this video, it will change how you think about silver for the rest of your life. I promise you that. But first, one number that changes everything. After the worst crash in 45 years, not a single major Wall Street bank turned bearish on gold. JP Morgan raised their target to $6,300. Deutsche Bank held at $6,000. Citi raised silver to $150. And Morgan Stanley told clients to put 20% of their entire portfolio in gold. 20%. That has never happened in the history of that bank. What do they know that you do not? Let me show you. It starts with a money trail, and this trail leads from Washington to Beijing. In November 2013, China held $1,006.7 billion in US Treasury bonds. They were America's #1 creditor, the biggest buyer of American debt on earth. Today, that number is $682.6 billion, the lowest since 2008. $634 billion pulled out. Think about that for a second. That is larger than the GDP of Sweden, larger than Switzerland. China removed an entire European country's worth of money from the American financial system. And the pace is accelerating, not slowing. In 2022, they sold $173 billion. 2023, $50 billion. 2024, $57 billion. 2025 through November, over $115 billion. They went from #1 holder to #3, behind Japan and the UK. Now, here's the question nobody on CNBC is asking. Where did $634 billion go? Money does not disappear, it moves. So where did it move? It went into gold, your metal, the same asset sitting in your safe or your brokerage account right now. 14 consecutive months of buying by the People's Bank of China. Not 1 month skipped. Not at $3,000, not at $4,000, not at $5,000. They bought every single month at every price level. Think about what that means. You and I hesitate when gold drops 2%. China bought through a 69% annual rally without blinking once. That is not trading. That is not speculation. That is a national directive with a timeline measured in decades, not quarters. In early 2023, China held 210 tons of gold. Today, over 236 tons, total value exceeding $319 billion. And those are just the official numbers. Multiple analysts believe China's actual holdings are significantly higher because they route purchases through state-owned banks that do not report to the IMF. But here is the number that should hit you like a freight train. And I need you to really stop and think about this. China's gold reserves are just 8.5% of their total foreign exchange reserves. Now compare that. The United States holds 66% in gold, Germany 68%, France 65%, Italy 64%, Russia, which started seriously buying after the 2014 sanctions, is at 30%. China is at 8.5%. Do you see what that means for your gold? Western central banks hold 65 to 68% gold. China is at 8.5%. If they want to reach even Russia's 30%, they need somewhere between 5,000 and 7,000 more tons. At today's prices, that is $700 billion to $1 trillion in purchases that have not happened yet. Think of it like a marathon. China has run 1 mile. The finish line is 26 miles away. Every ounce they buy from here pushes the price of every ounce in your safe a little higher. And they have 25 miles left to run. And it is not just China. Before 2022, central banks worldwide bought 400 to 500 tons per year. Since 2022, over 1,000 tons every year. 4 straight years at double the historical average. In 2025, total gold demand hit 4,974 tons, the highest ever recorded, more than during both world wars, the most gold ever demanded in a single year. JP Morgan forecasts 755 tons of central bank buying in 2026. Goldman Sachs says 60 tons per month. That is triple the pre-2022 average. So when someone tells you the gold bull market ended last Friday, ask them which central bank stopped buying. Go ahead, name one. You cannot. Now, gold is one half of this story. But what is happening in silver right now? Stay with me here, because this next section has numbers that should genuinely frighten anyone who does not own physical metal. The silver market has been in a supply deficit for 5 consecutive years, 2021 through 2025. The cumulative shortfall is 820 million ounces, roughly an entire year of global mine production gone, not sitting in a vault embedded in solar panels across Germany and California, soldered into circuit boards across Asia, inside EVs driving around Shanghai and Oslo. That silver is consumed. It does not come back. And mine production, it grows about 1% per year. Why? Because most silver comes as a byproduct of copper, zinc, and lead mining. You cannot just open a silver mine when prices rise. From discovery to production takes 10 to 15 years. The supply curve is glacially slow. The demand curve from solar, EVs, and AI chips is exponential. Those two lines are racing in opposite directions, and they are not going to cross anytime soon. 2026 is expected to be the 6th consecutive deficit year, no relief in sight. But wait, Because the inventory data is where it gets truly alarming. COMEX registered silver inventories have dropped 70% since 2020. London LBMA vaults down 40%, Shanghai at decade lows. The vaults are draining on 3 continents simultaneously. And here is the number that should keep you up at night. On COMEX right now, there are 356 paper claims for every single physical ounce of silver in their registered vaults. 356 to 1. Think of it like a game of musical chairs. 356 players, 1 chair. If even 3% of those paper holders demand actual delivery, the math breaks. The system cannot deliver what it has promised. Reports from January showed physical silver trading at $130 in parts of Japan, while Western screens showed 71. In Kuwait, 106. Your trading app and the physical market are telling 2 completely different stories. This is exactly why silver crashed harder than gold. The paper market is tiny and thin. When margin calls hit, there's no liquidity. Prices collapse mechanically. But the physical reality has not changed. 5 years of deficits, 820 million ounces of shortfall, export controls on 60 to 70% of supply, vaults draining on every continent, 356 to 1 leverage. Not one of those numbers moved on Friday. So when someone tells you the silver story is over, ask yourself, did the solar industry stop needing silver? Did the deficit close? Did China reopen exports? Did COMEX vaults magically refill? The answer to every one of those is no. Now, here is where I need you to zoom out. Because gold and silver are just the ammunition, the weapon China is building. That is something else entirely. And this is the part that should change how every American and European thinks about their money. If you have made it this far, stay with me, because what I'm about to show you in the next few minutes is the part of this story that no one else has connected. This is where it all comes together. Remember, I said there are 7 pieces to China's strategy. Gold buying is piece 1. Silver controls are piece 2. The silver deficit just made piece 2 even more powerful. Now, let me show you pieces 3 through 7. This is where it gets big. Piece 3, CIPS. Most people have never heard this word. CIPS stands for Cross-Border Interbank Payment System. It is China's version of SWIFT. And here is why that matters to you personally. SWIFT is how almost every international dollar transaction moves. It is also how the United States enforces sanctions. When America wanted to punish Russia, they cut Russian banks from SWIFT and froze over $300 billion of Russian reserves overnight. A sovereign nation's savings gone because of a decision made in Washington. Now, ask yourself this. If you were China, sitting on a $1.2 trillion trade surplus, and you just watched another country lose $300 billion overnight, what would you do? You would build your own system, and that is exactly what they did. In 2021, CIPs processed about $13 trillion. By 2024, $24.5 trillion, nearly doubled in 3 years. 43% growth in the last year alone. By mid-2025, the cumulative total crossed $94 trillion. 124 countries, 4,900 banks connected. I want you to feel what that number means. While you were checking your portfolio on Friday, 4,900 banks across 124 countries were already plugged into a system built specifically to move money without the US dollar. Does that sound like something that is going away? Think of SWIFT as the only highway between cities. Everyone uses it because there's no alternative. China just built a second highway, Narrower today, fewer lanes, but it connects 124 countries and traffic is growing 43% per year. And here's the thing about highways. Once people have a second route, they never go back to depending on just one. Would you? And in 2025, CIP opened its first direct partnerships in the Middle East and Africa. Those are the two regions where American financial influence is weakest and Chinese investment is deepest. That is not random. That is strategic. Piece 4. The Digital UN. China built a cross-border settlement platform called mBridge. $55.5 billion processed since 2022. The yuan accounts for 95.3% of volume. The People's Bank expanded its digital currency team from 40 people to over 300, built an international operations center in Shanghai in June 2025. Now, here is where it gets insane. Look at who the partner central banks are: Hong Kong, Thailand, United Arab Emirates, and Saudi Arabia. I need you to sit with that last name for a second. Saudi Arabia, the country whose 1974 deal with America created the petrodollar system. The agreement that every barrel of oil on Earth would be priced in US dollars. That deal has been the backbone of dollar dominance for 50 years. It is the single biggest reason America can run $36 trillion in debt and still have the world buy its bonds. And that country just joined China's digital yuan payment platform. What do you think happens when every oil-producing nation in the Gulf sees the Saudis at China's table? Do you think they wait? Or do you think they start asking for a seat too? And it does not stop there, because Saudi Arabia joining is not an isolated event. It is part of a wave. Piece 5. 1/3 of all Chinese trade is now settled in yuan. 1/3. A decade ago, that number was near zero. Let that trajectory sink in. When China buys oil from Saudi Arabia, sells electronics to Southeast Asia, trades with Africa and Latin America, a growing share of those transactions never touch a dollar at all. The dollar is not even in the room. And every percentage point of trade that moves from dollars to yuan is a percentage point of demand for your currency that disappears permanently. Does that affect your purchasing power over time? You already know the answer. Piece 6. And this might be the most clever move of all 7. Debt conversion. Kenya converted $3.5 billion of dollar-denominated sovereign debt into yuan-denominated debt. Ethiopia is considering the same. Here is why that matters to you. When a country owes dollars, it needs to earn dollars. It trades through SWIFT. It stays in America's orbit. But when that debt becomes yuan, suddenly it needs yuan. It trades with China. It uses CIPS. One conversion pulls an entire nation's financial gravity from Washington to Beijing. Multiply that across dozens of Belt and Road nations on 3 continents, and you see the pattern. It is not one dramatic move, it is 1,000 small moves, each one pulling a thread from the dollar's fabric. No, single thread breaks it. But your fabric gets thinner every year. Piece 7. And this is where it goes from strategy to doctrine. In 2025, Xi Jinping called currency strength a pillar of national power. That is the first time a Chinese leader has ever publicly framed currency as a weapon of geopolitical competition. And then they wrote it into law. China's 15th five-year plan, 2026 through 2030, explicitly prioritizes yuan internationalization as a strategic national goal. This is not a speech, this is state policy for the next 5 years. The second largest economy on Earth just told you exactly what it is going to do. The question is whether you are listening. Now, before I connect all of this, I owe you honesty, and this is important. The dollar is not dying tomorrow. It is still 56% of global reserves. The UN is 2.6. In every crisis of modern history, the world runs to the dollar, not away from it. China has capital controls, a shallow bond market, and a legal system controlled by the party. These are real limitations. Anyone telling you the dollar collapses next month is selling fear. Do not buy it. But the monopoly is ending. In 2000, the dollar was 72% of reserves. Today, 56. 16 percentage points in 25 years. Not a crash, an erosion. And in that erosion, both sides need hard assets. America needs gold to maintain credibility. China needs gold to build it. That is the scenario where gold wins, no matter who wins the geopolitical chess match. It is like two restaurants in a town that used to have one. The old one is bigger, more trusted, but the new one is open, and every year more people eat there. For the farmers who grow the food both restaurants need, business has never been better. Your gold and silver, you are the farmer. Now, with that honest context, let me connect all 7 pieces for you in one breath. Sell US Treasuries, $634 billion and accelerating. Buy gold, 14 months straight. Restrict, active January 1st. Build SIPs, 124 countries live. Launch digital UN, Saudi Arabia on board. Settle trade in UN, 1/3 converted. Convert dollar debt to UN, Kenya done, more coming. Every single step is live. This is not a plan, this is execution happening right now. And here's the line I want you to carry with you. China is not attacking the dollar. China is building an exit from the dollar. And that exit is paved with gold. So where does this go from here? What are the biggest banks on Wall Street actually saying about your metals after the worst crash in decades? JP Morgan targets $6,300 gold. They did not say that before the crash. They said it after. They watched gold lose 21% and raised their target. Their forecast has gold averaging 5,055 in the fourth quarter, rising to 5,400 by end of 2027. Deutsche Bank and UBS both see 6,000 or higher. Goldman Sachs holds at 5,400. Those are 4 of the biggest financial institutions on the planet, all bullish, all after seeing the crash. But here's where it gets really interesting. Some analyst models using algorithmic and technical projections see gold reaching 7,000 to 8,500 by the end of this year. Long-term forecasts from multiple research houses put gold between 17,000 and 21,000 by 2030. The extreme targets may sound outlandish today, but the direction every single one of these forecasts points the same. Up on Silver City raised to 150 after the crash. Not before, after. Let that sink in. Silver lost 41%, and Citi's response was to raise the target. Long forecast models project 142 to 163 by year end. Peter Brandt, a 50-year commodities trading legend who correctly called the 2011 silver top, wrote after the crash, and I want you to hear his exact words. Quote, 2026 is not 2011. I believe there is more ahead for silver. End quote. Now, here is the historical pattern that ties everything together, and this might be the most important 60 seconds of this entire video. In the 1970s, gold went from $35 to $200. Then it crashed 50%. Analysts said the bubble was over. Regular people sold at the bottom. Then gold went from $100 to $850. 8.5 times after the crash everyone thought was the end. Silver did the same thing. $150 to $6. Crashed hard. The average investor gave up. Then it exploded to 50. Does last Friday feel familiar now? Does a 41% crash after 250% rally sound like something you have heard before? History does not repeat exactly, but it rhymes. And what happened on January 31st looks remarkably like a mid-cycle shakeout, not the finish line. The intermission here is my personal take, and I want to be straight with you because I think you deserve that. I started going down this rabbit hole the morning after the crash. I watched the numbers on my screen turn red like everyone else, and I needed to know if the thesis was broken. Was the data still there, or had something fundamentally changed? So I started pulling filings.